Hey, everyone, and welcome to this explainer. If you've ever felt, a little anxious about the markets, or maybe you're just unsure of exactly how much risk you should be taking with your hard-earned money, trust me, you are absolutely not alone. Today, we're going to break down a step-by-step approach to evaluating your personal financial risk tolerance. We're going to figure out exactly how you can build a serene, secure strategy together.
Okay, let's just glance at our roadmap for today. We'll start with everyday risk, then look at your personal profile, measure volatility, check out the history and numbers, dive into the magic of diversification, and wrap it all up with your step-by-step strategy.
Section 1. Everyday Risk, Demystifying Uncertainty. To kick things off, we really need to normalize the idea of risk so it doesn't feel so overwhelming.
Ask yourself right now, are you taking risks today? Because the truth is, you're actually already a highly experienced risk manager. You do this intuitively every single day without even breaking a sweat.
Seriously? Think about it. The most mundane daily activities carry inherent risks. Getting out of bed, drinking a hot cup of coffee, or getting behind the wheel of a car. All of these involve a calculated level of danger. Yet, you weigh the benefits against the potential downsides, and you take deliberate action anyway. You don't just stay in bed forever because you might stub your toe.
So the crucial takeaway here is that financial risk isn't just about the possibility of something bad happening. As finance professor Aswath Damodaran points out, it's really just the probability of both good and bad outcomes when you're actively chasing a reward. Because so few opportunities are a sure thing, you literally have to accept the possibility of a bad outcome to capture the gain. It's exactly like driving a car to get to an awesome destination.
Moving on to Section 2. Your profile. Know thyself. Let's see how this everyday logic applies to your psychological makeup.
Because before you look at the markets, you really have to look in the mirror. Damodaran loves to quote Shakespeare on this, "To thine own self be true." Your financial security hinges entirely on knowing your personal strengths and weaknesses. Humans are naturally risk-averse, sure, but our individual tolerance levels vary wildly. You don't need to try and be the next Warren Buffett. You just need to be the best investor for your specific personality.
Now look at the stark contrast between these mindsets. On one hand, you've got the conservative investor. They want steady security, they look decades into the future, and they're totally cool with moderate returns. Compare that to the adventurous speculator who's willing to take on incredibly high risk for a shot at quick profits. If you're a beginner looking for financial security, you absolutely belong in that conservative camp. Just acknowledging that up front is going to stop you from making panicked, emotional decisions when the market gets bumpy.
All right, Section 3. Measuring volatility and VAR. Simplifying the math. Because once you know your profile, it's time to actually quantify that risk.
Simply put, volatility is really just the gap between your absolute best-case scenario and your worst-case fear. When an asset is highly volatile, that gap is massive. When it has low volatility, the gap is narrow. Defining exactly what kind of downside you're trying to avoid is a huge leap forward in taking control of your money. To do this, big financial institutions use a statistical tool called value at risk, or VAR for short. Now, the math behind it can get pretty deep, but the concept is beautifully simple. Basically, VAR might calculate that under normal market conditions, there's only a 5% chance that your portfolio will exceed a specific maximum loss over a certain time frame. It literally gives you a mathematical boundary for your worst fears.
And breaking these probabilities down like this, it's a game changer because it validates our intuition with hard data. In a normal market, the probability of a major loss is low, maybe around 5%, which lets you stay totally serene. Now, during a historic crash, investors tend to panic, but statistically, those massive crashes are very low probability events, often around just 1%. Seeing this data proves that the sky isn't falling every day, which really helps you keep your cool when the news cycle is just screaming at you.
Section 4. History and numbers. Validating your intuition. But here's the catch. Numbers alone usually aren't enough to keep you disciplined.
Because as humans, we don't just run on spreadsheets, right? We run on stories. Damodaran argues that investors have to bridge the divide between numbers and narrative. You have to craft a coherent, personal story to justify your financial choices. Basically, marry your raw data with an emotional story that you truly believe in. A story without numbers is just a fantasy, but numbers without a story, they lack soul, and they won't keep you committed when the going gets tough.
So, to test if your narrative is actually sound, and not just a fairy tale, you can use the rigorous 3Ps method. First, check if your financial goal is mathematically possible. Second, is the story plausible given current market realities? And third,
And honestly, most importantly, are the profits actually probable? Running your ideas through this logical filter stops you from chasing hype and keeps you grounded in reality.
Section 5. The magic of diversification. Limiting losses. Now we're getting to the really good stuff.
Because now that we have our story and our numbers aligned, we can apply the single most powerful risk management tool of all time, diversification. Nobel laureate Harry Markowitz actually called it the only free lunch in investing, and this perfectly illustrates why. During the massive 2008 financial crash, if you were undiversified and just held the broader stock market, you suffered a terrifying 37% drop. Ouch. But a highly diversified approach, like the famous Ray Dalio portfolio, limited its losses to just 3.9% during that exact same crash. I mean, that is literally the difference between total panic and complete serenity.
This specific resilience happens by spreading your bets across different asset classes. By holding 30% in stocks, 55% in bonds to cushion the fall, and 15% split between gold and commodities as an inflation hedge, the portfolio becomes practically bulletproof against economic surprises. It proves you don't need a crystal ball to predict the future as long as you're well diversified today.
Finally, Section 6. Your step-by-step strategy, a practical guide. Let's pull the whole shebang together.
Here is your actionable 4-step checklist to adjust your strategy today. Step 1. Assess your true comfort zone. Are you conservative or are you adventurous? Step 2. Build a logical story using those 3 Ps to back up your goals. Step 3. Spread out your investments. Diversify, so a single bad event doesn't wipe you out. And Step 4. Review and rebalance your progress just once a year. Seriously, stop checking your portfolio every single day and just tune out the daily financial news noise.
As we wrap up this explainer, I want to leave you with one final thought. Ask yourself, what narrative is your current portfolio following right now? Does it actually align with your true risk tolerance? Or is it time to rewrite your financial future?